Good evening, ladies and gentlemen. The second video cast for the evening for the end of the week report, Clueless Trading. We're going to start this with the Russell 2000, the U.S. small cap growth. In the old days, back when I was active on StockTwits, one of my biggest winners, both on the long and short side, but primarily on the long side, was the Russell 2000. My term that I used was the U.S. small cap infantry marches on. Once I said the U.S. small cap infantry, aka our brave Marines, took Fallujah. People who are a little bit politically in tune know exactly what I'm talking about. We fought that battle in Iraq. We lost the first time, and then our boys took it out big. Everyone is negative overall. Majority of the investment public, the Wall Street community, traders in our community at Clueless Trading, not to mention on StockTwits and other forums. Everyone's scared. We're all terrified. Every little drop is the end of the world. The U.S. economy is completely lost. U.S. business, small business growth is dying. That's all we hear. Now, I'm not here to make a political statement or to change anyone's mind or their mindset about what they're thinking or not thinking. Cognitive bias is one of the key determinants of trading. Successful trading says we have to be less emotional and far more robotic. Easy to say, very hard to do. But if you practice it every day, just like sitting for 10 minutes and meditating or just taking time out on your own and just blanking out your mind and just letting your thoughts calm down. That's as robotic as you can get. So when it comes to being robotic, I try to do it every single day. I'm human, just like all of you. I take my losses, just like all of you. I have more winners than losses. That's the reason why I'm still doing this. Actually, that's not why I'm doing this. I'm doing this because I don't have a choice. I love what I do. I am passionate about it. But this is my living. This is what I do to pay my bills, to keep my family in good order, to put food on the table. Some of you might think the stock market's a gamble. Just get in there, try to make some money, get out. Well, good luck, because the stock market is not a gamble. It's a quantifiable model that if you really know how to do it, you will be successful. Many have come and gone through our service. And when markets get this volatile and this tricky, some drop off. They give me excuses like I'm taking a break. And guess what happens? 2 months from now, 3 months from now, 4 months from now, the market's roaring and they come back. And it's a tragic statement on human behavioral modeling, because the time to be truly excited, the time to be truly passionate and grit, the article that I put out there on my real-time Twitter feed, read it, is to be when markets are retracing, when the markets are at extreme oversold levels, where despair is the key word, or retracement levels, as we're talking about now, technical retracement levels, which we're going to go through in a few minutes. These are the times to be excited. These are the times to pack up your bags and leave town. But that's what the majority do. I was telling my son over the weekend, and he's a big car freak. Okay? I said, if a $100,000 car is on sale for 40%, would you literally wait in line and sleep out there on the pavement, trying to put your name out there so you could get in? The answer is obvious, yes. When stocks sell off, good stocks sell off, on technical basis, the market sells off 2, 3, 4, 5, 6, 7, 8, 9, 10%. There's no lines. There's nobody lying on the pavement saying, I'm going to buy this or that. You got to drag people out and show them all this stuff, and maybe some of you guys get in. It's hilarious. It's actually pathetic, if you ask me. But this I've seen over the years, over and over again. I dealt with this with clients, institutional clients, retail clients, i.e., human beings. I deal with this in my service with my traders. I know when the room gets silent and quiet and gets jubilant and euphoric when things are moving higher. What a shame. The time to be euphoric and joyous is when you're seeing some bargain level prices on a technical basis. So let's move on. All right. You guys all know what I'm talking about, but few of you practice it. I try to practice it every day. So if I have a hard time practicing it, I can imagine what the rest of you guys and girls are doing. Okay. So here we are at some pretty critical technical levels. The US small cap market, which benefits the most from a stronger US economy. Political stuff is also involved. I put out a very important article today which talked about a Trump presidency, if it happens, could bolster the markets in a big way. Keep in mind his protectionist views, if it comes into play, tariffs and all that on foreign goods from large trading partners like China and Japan and Mexico, will harm large cap companies, but US small cap growth, which depends on US domestic buying, will benefit. So, where are we right now? We are testing a upwardly rising, keyword, upwardly rising 50 and 34-day moving averages. This is a falling wedge or a consolidation channel. We're not asking for the moon. We are saying that if this thing is truly a retracement bounce, in that particular case, it's going to basically, let's say this pattern right now is still a head and shoulders. So here's your head, here's your left shoulder, and your right shoulder will come into play at this level. So I simply said from a trading tactical standpoint that I posted many times, and focused and disciplined members listen to it, that we are looking to a move from about 1100, and we had a powerful day on that on Friday for people who listened and bought at the lows, looking at possibly 1130 to 1135. That's 30 points from 1100. So if you want to be tactical and forget about the bigger picture, then you got 30 points in there. You can buy something at 5 and sell it at 15 or 20. So when you don't do that and you start chasing it at the right shoulder, if it's a right shoulder, then you're stupid. I'm sorry. Because this moves like this, which I think is going to happen, and then it can just collapse and move real fast down. And I'll be there to take full benefit of it. And just like the S&P, we could test the 1080 level here, possibly test the DT line. I'm sorry, this is actually the channel that the Russell 2000 was trading in, this channel. It broke down on that back on January when we had that huge, massive, downturn. So the test of that on the lower channel is around 1050 to 1057. Very clear. But before that, you're going to have a quick tactical bounce. That tactical bounce may take us up another. We closed at 1114.72. Could take us up another 20 points. Take the 20 points. And then we see what happens. In the meantime, look at the internals. We had a big crossover here. Looks like we're going to have a crossover. And in my opinion, this is one thing I've found. We never act at deep oversold levels. Well, I do. But I don't act forcefully because we don't have, excuse my French, FU money. We're not Saudi billionaires, or we're not Donald Trump, and we're not, somebody else. We don't have billions of dollars to just throw out. We're simple folks. We're trying to make a living. So maximum aggression should be at these levels when we are below the RSI of 20. We're at RSI 1026 right now. See that? So at this point, if you go aggressive long, generally speaking, you get a powerful bounce, swing bounce, mind you, up towards overbought levels again, which is above 80. Remember, the STOs are nothing but the first derivative of the relative strength index. And at that point, you sell. So I believe that if this works out, then we get 30 points on this. I'm sorry, 20 points this, and possibly a little bit higher. Maybe test the upper end of this large channel, which is 1145 or so. That's a heck of a lot of money. 1114 to 1145 is 30 points. By that time we get overbought, then you can play the swing again. Now, is it as easy as it sounds? No, but in hindsight, it is. Because if you do it methodically, robotically, then you can win big time. Now, intraday volatility and all that stuff, that's always here to stay. We have to deal with it. Doesn't feel good, but neither does hard work. Right? Neither does hard work. So the key is, let me get all this out. On the Russell 2000, this is nice. This is a beautiful pattern. That was a consolidation channel 2, a consolidation wedge, a move up over the 34-day moving averages, which is around possibly around like 1120, would bring us up towards the upper end of this game, which is around 1145. Along the way, we'll find major resistance at 1135. Right there, 1135, and a breakout over that will be 1148. This is encouraging. Let's see how it pans out. End of story. Let's move on to the good old biotech index. The biotechs are the sexiest and the hardest stocks to trade. I have done extremely well in pinpointing many from tactical levels that have selective stocks that have done extremely well. The biotechs are extremely volatile for a simple reason. They're biotechs. They have FDA approvals, they have clinical trials that work out, don't work out, all kinds of wild stuff. So looking at this, when I call the biotech buy down here at this level, let me get this. At these levels at 240, it did work out. We did go to 290, almost 295. Yes, we didn't get up and create this massive move to 340 yet. And we fell. So at this point, the lower end of the real buy zone is around 245. And a break of that would be really negative. That means we're looking back at 240 again. But the fact that we are below on the daily, the 34 and the 50-day moving averages, which have still haven't had a negative crossover or a death cross. The crossover, the positive, we'll call it what? The birth cross? I'm not sure, right? Right there, back in April, is still intact. The 34 and the 50 are still intact. Yes, they're not rising the way they should, which would be like this, like I showed you in the other indices, but they're still there. So at this point, the standard deviation away from the 34 and the 50 is probably -1. What does that mean? It simply means that there is a possible bounce coming after a quick slippage, probably a little bit lower, back towards the 275 level. Do you want to make 35 points from the 240 level? Just the way you could have made 240 to 290 plus 50 points on the IBB calls. which some of you did, many of you didn't. So don't keep on missing out on opportunities. Now, selective biotech stocks like MDVN, which is a major buyout candidate, right? Smaller biotech stocks like PTCT, Regeneron, which is coming off some horrific lows, Illumina, and all these particular stocks, okay? The really cheap ones. Oh, and Sarepta, which has May 26th as their next FDA decision whether or not their experimental drug gets approved. Now, these are specialized situations, right? So as a trader, you have to play risk. You want certainty that all these stocks are going to work out. That Metavision made me what's it called? I can't even say the name. Because Metavation is going to get bought out at 80. I don't know. All I know, the stock is being bid and there are multiple suitors. They probably buy the stock at 65 or 70. We've been buying the stock since the low 50s. And the stock is sitting here at 60. So you got to do what you got to do. The index itself is telling you that it goes a little bit lower and then it bounces hard. Okay, let's take a quick look at the proxies, the Vix index and the RVX, which is the Vix for the Russell 2000. I said I put a chart out there which should be put up in the Museum of Modern Art. It said, would you buy this chart? And I put that on Friday, and that is your VIX right here. This is a disgusting chart. The VIX is saying that it wants to get to was 13, but then at the same time, I shouldn't say it's a disgusting chart. Yes, on face value, it looks disgusting because it could come and test this 50 and the 34-day moving average and move fast. And that means the market's going to move up a little bit and then, boom, pull back hard. But this, ladies and gentlemen, to me looks like a bear flag. A bear flag generally breaks down. So where is the VIX going? Somewhere around 12 and 13. That means the market is going higher over the short term. This is not good either on the internals. Now this is technicals. The VIX could very well hit this 34 and the 50 moving average and then make a move up to the upper end of the channel. And it breaks the upper end of the channel, we're looking at 21. That means the market is going to move down. So track the VIX, RVX. Face value, looking at the chart, you wouldn't buy this chart. I could sell you a bill of goods on this and say, oh my God, this is looking really good and this and that. You'd be like, you know, Frank's crazy. This is not a good looking chart. What it's basically telling you, and this is the proxies, the inverse proxies on the market. You know, be intelligent. You know exactly what I'm talking about, right? So here's your downtrend line. The white line should be in red. These are the big downtrend lines. And here it hit the downtrend line just like clockwork. And now it's testing the 34. It could bounce off the 34 and break out and go towards 24. That means the Russell 2000 is going to come down to 1180. However, if you look at the internals here, it's telling you that there is there's a higher probability of a curl down, which means it's going to get oversold again. So the RVX, which is the VIX for the IWM and the RUT, right? Volatility index, the fear index. If it comes down to 16, that creates a beautiful floor for it to bounce big time over this and heads towards 24. That means the Russell 2000 will head towards exact points that I mentioned to you before. Everything works in hand. It's all mechanical. It's all mathematical. We'll head towards that 1135 level, if not 1148. That's only if the RVX breaks down below the 34 and comes down to a 16. And at that